You hear a lot of hype about Airbnb these days. The market is absolutely obsessed with their brand, but hiding in plain sight is a quietly superior, cash-generating powerhouse that is completely crushing it, yet trading at a massive discount. We're talking about a company facilitating unbelievable transaction volumes globally, yet the broader conversation completely misses the actual financial reality of what's happening under the hood. There is a massive disconnect between the cultural hype of travel platforms and the raw economics of who is actually capturing the profit. This explainer is going to strip away the noise and look at the mechanics of a business that has quietly positioned itself as the undisputed apex predator of the digital travel ecosystem. Just look at this. In the first quarter of fiscal year 2026, Airbnb posted a 3% operating margin. Booking Holdings, a staggering 25%. This stark contrast proves right out of the gate that our analysis today is going to be driven by hard financial realities, not hype. When a company operating at this immense global scale maintains a 25% margin, while its most famous rival scrapes the low single digits, it tells us there's a structural advantage built into the very architecture of the business. Booking Holdings isn't just surviving against new age competitors, it's financially crushing them. It's extracting value from the travel supply chain with a level of ruthlessness and efficiency you rarely see outside of big tech monopolies. And all that operational efficiency translates directly into this massive figure, $9.09 billion. That is the sheer amount of free cash flow Booking generated in fiscal year 2025 alone. To put that into perspective, think about traditional hospitality giants. A traditional hotel chain has to build physical infrastructure, acquire real estate, renovate lobbies, and manage massive capital expenditures just to maintain their revenue base. Not Booking. They operate an infrastructure made of code. It requires minimal physical capital reinvestment. That means almost every single dollar of operating cash they generate turns into pure, unrestricted free cash flow. So the central tension we have to resolve today is this. If the economic engine is this powerful, why on earth is the stock currently priced by the market as if the business is bracing for a severe structural slowdown? Section 1. Quick context. Inside the cash machine. To understand the valuation disconnect, you first need to understand how this business actually makes its money today, because things have fundamentally shifted. Historically, Booking operated primarily on the agency model. They acted purely as a digital matchmaker. You booked a room on their site, the hotel collected your payment at the front desk when you checked out, and then the hotel paid Booking a commission weeks later. Well, that model is now down to roughly 29.6% of their revenue. The new economic engine is the merchant model, which now accounts for nearly 66% of total revenue. Under this model, Booking acts as the merchant of record. They collect your payment up front, long before you ever pack your bags. Strategically, this lets them bundle flights, rental cars, and hotels into a unified package they call the connected trip. But financially, the implications are massive. By collecting cash up front, they hold your money before the trip happens. In an environment where interest rates are above zero, holding billions of dollars of traveler prepayments for weeks or months generates massive, risk-free interest income. It's essentially a secondary revenue engine bolted onto the core business, driven entirely by the float. Section 2. What is driving the business? The payment architecture is incredibly lucrative, but what are the structural competitive moats actually protecting this engine? Well, a major market misconception is that Booking is just a traditional hotel platform. It isn't. Booking now has 4.5 million alternative accommodations. We're talking vacation rentals, private homes, cabins, and city apartments. This directly challenges Airbnb, which has roughly 5.5 million listings. Booking didn't just stay in their lane. They successfully leveraged their massive European hotel dominance to cross-sell alternative accommodations to their existing users. By the second quarter of 2026, alternative accommodations represented 37% of total Booking.com room nights. They're proving that travelers care more about having all their options in one trusted app than they do about the cultural cachet of a specific brand name. But the real structural advantage, the true competitive moat, lies in their direct traffic mix. Booking has over 150 million active mobile users globally. Because of this massive two-sided network effect, where the most travelers attract the most property listings, and vice versa, their direct channel bookings sit consistently in the mid-50s to mid-60s% range. Why does this matter so much? Because in the digital travel economy, there is a Google tax. Every time a traveler goes directly to the Booking app on their phone, instead of Googling hotels in Rome, Booking bypasses a costly Google search ad. If you don't own the customer relationship, you have to rent it from Google. Booking's massive direct traffic advantage dramatically lowers their customer acquisition costs, widening their moat against regional competitors who are forced to bid up ad prices just to survive. Section 3. The central conflict. The market's concern. It's not all clear skies, though. Intelligent investors know there is a massive threat looming over this cash machine, and it's exactly why the valuation is currently discounted. We have to ask the hard question: what could actually break this thesis? If the margins are high and cash is flowing at record levels, what is the broader market so terrified of? The threats are entirely structural and regulatory. First, Booking was designated a gatekeeper under the European Digital Markets Act, or the DMA. This regulation explicitly bans price parity clauses. Historically, Booking forced hotels to ensure they couldn't offer a cheaper price on their own direct website than they offered on Booking.com. Well, under the DMA, European hotels can now legally undercut Booking's prices on their own sites. This directly threatens Booking's core take rate because consumers could theoretically use Booking for discovery and then bypass them at checkout for a cheaper direct rate. Add to that a recent €413 million antitrust fine in Spain, signaling a highly hostile regulatory environment in their most profitable geographic region. Finally, there's the lingering Google dependency. Despite their massive direct traffic, they still spend roughly $22 million a day on performance marketing, mostly to Google, just to defend their remaining search traffic from competitors. If the DMA causes direct bookings to slip, that daily ad spend will have to skyrocket, which would immediately crush their operating margins. Section 4. The earnings evidence. And by the way, if you like deep evidence-based stock breakdowns like this, make sure you're subscribed. So are these regulatory headwinds fundamentally crushing the business, or is the cash machine outrunning the regulators? Let's look at the hard evidence from the Q2 2026 earnings report, announced on August 4th, 2026. The business didn't just survive the European headwinds, they beat analyst expectations across the board. Total revenue hit $7.35 billion and over 8% year-over-year growth. Adjusted earnings per share rocketed up 15% to $2.54, showing massive operating leverage. And gross bookings hit a staggering $51 billion for the quarter. What this showed the market was that despite geopolitical tensions and the looming shadow of the DMA, global travel demand remains incredibly resilient, and Booking continues to capture an outsized share of it. The market realized the core engine was perfectly intact, and the stock jumped over 6% the very next day. But the most important piece of evidence from that earnings call, the number that long-term investors really focused on, is this. Management officially upgraded their transformation program guidance, now targeting $650 million in annual run rate savings by the end of 2027. Where's this massive efficiency coming from? A combination of flattening management layers, optimizing their global real estate footprint, and aggressively deploying generative AI to automate vast swaths of customer service inquiries. They're drastically reducing the need to scale human call centers. So even though management guided for a slightly slower room night growth in Q3 due to normalization trends, the margin expansion story is completely intact. They are getting leaner and significantly more profitable while still growing top-line revenue. Section 5. Qualitative Scorecard. Moving beyond just one quarter's raw numbers, we need a holistic evaluation of the business quality. This scorecard synthesizes the entire operational health of Booking. They earn a highly impressive blended score of 8.6 out of 10, but the real story is in the standout pillars. Profitability is a perfect 10, management alignment is a 9, and capital allocation is a 9. CEO Glenn Fogel and his team have executed an absolute masterclass in capital allocation. They've overseen a massive, aggressive share count reduction program, shrinking the total outstanding shares by over 40% since 2014. Think about the math on that. With 40% fewer shares in existence, every remaining share you hold owns a drastically larger piece of that $9 billion in free cash flow. Combine that aggressive buyback with the introduction of a new quarterly dividend in 2026, and you have a mature management team that is perfectly aligned with long-term shareholder returns, acting with extreme discipline rather than chasing reckless acquisitions. Before we break down the 5-year scenario projections, I want to mention that all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports exactly like this one for literally any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. Now, if you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders for quality businesses built to compound for years, hidden gems for under-the-radar names with asymmetric upside, and dividend hunters for durable income with the fundamentals to back it up. You also get Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access it on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Section 6. 5-year scenario analysis. Before we look at the numbers, I need to clearly state, this is a hypothetical framework for thinking about possible outcomes based on operational math. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. And if you want to access the full model with all the detailed assumptions for each scenario, you can check out the detailed research report at flash.StockSentinel.ai. Let's start with the base case, carrying a 60% probability. This assumes that international travel normalizes without major macroeconomic shocks, and they successfully hit that $650 million savings target. If top-line revenue compounds at a steady, normalized rate of 8% annually, net margins expand slightly to 23%, and management continues aggressively buying back 4% of their outstanding shares every single year. Applying a conservative 21 price-to-earnings multiple, which is highly conservative for an asset-light tech compounder with an entrenched moat, gets us to a $311.80 target price. That represents a very solid 8.54% annualized return over 5 years, driven purely by steady operational execution and share count reduction, not speculative multiple expansion. Now, here is the high case, carrying a 20% probability. What has to happen operationally for this to materialize? Well, Booking needs to aggressively capture market share from Airbnb in the highly lucrative U.S. alternative accommodations market, and their new generative AI tools have to fundamentally alter their cost structure, massively reducing customer service overhead. If that successful execution pushes revenue growth to 11% and net margins up to a staggering 26%, the free cash flow generation explodes. They use that cash to buy back 5% of shares annually, the market recognizes the dominance and awards a 24 multiple, and we see a target of $486.80. That is an exceptional 18.65% annualized return. But we must honestly examine the low case, which also carries a 20% probability. This happens if the European DMA parity bans successfully change consumer behavior, allowing hotels to redirect checkout traffic to their own direct websites, all while a global recession hits discretionary travel spending. The underlying math gets ugly fast. Revenue growth slows to a sluggish 4%, margins compress heavily down to 18% because Booking is forced into an expensive bidding war on Google to replace lost traffic. The market aggressively punishes the stock, contracting the multiple severely to 15. This scenario results in a target price of $133.56, translating to an annualized loss of over 8%.
Section 7. Risk Analysis.
Because that downside scenario is grounded in real structural threats, we need to dedicate specific focus to risk. What actually matters to the fundamental health of this business? There are exact, concrete, early warning signs you need to watch for in the upcoming quarterly reports. Forget the broad market noise. First, watch for a sequential contraction in the forward booking window. If consumers start booking trips much closer to their travel dates, it's a highly accurate signal of rising economic anxiety. Second, monitor if constant currency average daily rates, or ADR, fall below 0%. That signals hotels are slashing prices to fill empty rooms. And crucially, if you see marketing expenses organically exceed 5.2% of gross bookings, that is the canary in the coal mine. That specific metric tells us their powerful direct traffic advantage is eroding, and they're being forced to pay Google too much money just to acquire customers. That is how you know if the thesis is actually breaking in real time.
Section 8. Wrap up.
Let's pull this narrative back together and completely resolve the curiosity gap we opened at the very beginning regarding the valuation disconnect. The core investment thesis boils down to 3 definitive realities. First, their structural moat is actively expanding. They are matching Airbnb and alternative listings and capturing a much wider piece of the global travel ecosystem. Second, their margin dominance is real and sustainable, driven by the massive interest float of the merchant model and an aggressive $650 million transformation savings target. And third, the valuation disconnect exists solely because the market is pricing in a regulatory slowdown despite incredible compounding free cash generation. Going forward, the absolute number one thing to monitor next is exactly how the European DMA regulations impact their overall take rates over the next 2 quarters. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.StockSentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.